Folks, we're going to get started. Can you hear me? I think you need, thank you. If you haven't got headsets, you won't hear a thing. For those of you that are in the club, yes, headsets are good. These people at the front, they don't know what they're missing. Folks, I'm Sean Kidney. I'm the CEO of the Climate Bonds Initiative. If you haven't heard of us, just think green bonds. Just think $4 trillion, and you got where we're coming from. Growing fast, including issued by the New Development Bank. There are green bonds all over the world. But today we have a very specific agenda. We're talking about risk-sharing instruments of multilateral development banks to support private capital mobilisation in emerging markets and developing countries. What we really mean, we're talking about ways to get a lot more money flowing to emerging markets quickly, and how development banks can support that to make it happen. That's really what the game's about. You know the challenge. We have incredible requirements for investment, even before we deal with climate. With the emerging market, building of cities, building of industries, building of societies, the amount of investments, about 70% of infrastructure investment in the next 30 years will be in emerging markets. There are huge capital needs. It dwarfs what's available from the public sector. We can't do this with New Development Bank and AIIB alone. We have to have private capital to the table. We need to support investments that can come forward with private capital. This is where blended finance instruments, risk-sharing instruments start becoming critical. To make it happen, we are going to need the public sector institutions we have to think very carefully about how they can support the mobilisation of capital. Well, that's just an introduction, really, for my good friend, who's going to talk about that as he comes forward. To kick us off today, I'd like to invite Anil Kishore, who's the Vice President, Chief Risk Officer for the New Development Bank, one of those institutions that's going to show us what to do. Anil, please take the panel here.
Distinguished guests, dear colleagues and esteemed partners, good evening and a warm welcome to you all on behalf of the NDB. Our sincere gratitude to the esteemed panelists and to the audience for making time to be part of this event. In today's event on sharing instruments of MDBs to support private capital mobilization in emerging markets and developing countries, we focus on the role that multilateral development banks play in mobilizing private capital to meet the urgent sustainable development and climate needs of emerging markets and developing countries. Today we have with us a group of experts with a diverse range of experience as we continue to search for solutions to mobilize private capital towards a sustainable future. Their insights and ideas will be helpful. Ladies and gentlemen, various studies continue to point out that financial resources available for developing countries to fund their 2030 agenda are vastly outweighed by their needs. It is estimated that these countries face an annual financing gap of about $4 trillion to achieve the UN SDGs by 2030. If the SDG investment needs to 2030 are to be met, some $30 trillion of additional investment is cumulatively required. More than half of this, or $2.2 trillion, relates to the energy transition alone. Is there a way MDBs can play a bigger role in closing this huge financing gap? Leveraging their own capital is just not enough. MDBs operating as a system need to significantly ramp up their capacity to mobilize private sector resources. MDBs have been expanding their roles as catalysts for private capital, development of diversified financial instruments, project-specific investment, vehicles and technical assistance initiatives that support project preparation and readiness have proved useful. To attract more private investors, MDBs are also looking at innovative risk sharing and de-risking strategies. Today, we look forward to our panelists to hear about their strategies for catalyzing or crowding in private finance in EMDCs. By reflecting on successful case studies and effective models, we can identify what has worked and how these lessons can be scaled across regions. Private capital pools can be transformative. The issue is to find the right recipe to unlock them for meeting our climate aspirations. We also have to explore better the risk mitigation tools that are essential to pull in private investors into high potential yet challenging markets. MDBs can play an important role by using financial instruments like guarantees, blended finance, local currency loans, and other mechanisms to make investments in EMDCs less risky and more attractive. We need to understand the impact of these tools and evaluate how MDBs can further expand their use to overcome investment barriers, foster resilient investment environments, and tap the vast potential of private capital. As steps to strengthen collaboration among MDBs, DFIs, and the private sector, and of course the governments, are essential. Effective partnerships are fundamental for creating a scalable financing solutions that meet the climate finance needs. Ladies and gentlemen, let me conclude by repeating the obvious. Private capital mobilization is essential for achieving the climate goals globally. A stronger collaboration with private players, leveraging of our convening power to remove roadblocks, a strategic de-risking, and targeted innovation can probably catalyze a level of private capital which bridges or meaningfully curtails the current climate financing gap. Let's listen to what our expert panelists think. Thank you.
Thank you, Anil, for joining us today. Anil, of course, has a long and illustrious history at the State Bank of India, more commercial sector, bringing that to this area. In other words, dealing with real-life investment. The NDB is one of those institutions that is becoming greener as we speak. Their first bond they issued was actually a green bond, which is an example of tapping the market. But of course, other institutions joining us today have done amazing work too. Please, let me welcome up Mr. Mafoma Kwale, Group Executive, Transacting Infrastructure Dealing. It's a very long title, Mafo, at the Development Bank of Southern Africa. Please join me on the stage. Mr. Rodrigo Salvado, Director General, Operational Partnership Department of the Asian Infrastructure Investment Bank. Dr. Mohammed Hedi Mejai, Director, Investment Department of the Islamic Development Bank. Ms. Svetlana Radchenko, Chief Private Sector Department of the New Development Bank, please. And have we got Mr. Thomas Brostrom here? Oh, yes, we have. Chief Business Development and Investment Officer at Aqua Power. Aqua is one of my favorite companies in the whole world. Last night, I had the opportunity to sit next to one of your other senior execs talking about the amount of investment in renewables doing in Uzbekistan. I had no idea. It's incredible. A company that started very brown, that's going very green, who will tell us what they really want from the development banks, right? You're gonna put the hard word on them for us. But look, let me start off to say, you know about the mitigation agenda, right? This is what COPs are about. If you don't know about it, then what the hell are you doing here? Of course you all know about it. But the resilience agenda, this is relatively new for us because climate impacts have started hitting. Think of the floods, the droughts, the storms we've seen in the last year, records being broken around the world. We have to prepare now. We published the climate bonds initiative, a climate resilience taxonomy with UN Women and UN Disaster Relief a couple of months ago as a first step in various taxonomies that we're doing around the world, like in Brazil and Rwanda, resilience criteria being put into it. I'm saying this because as we look at the right kinds of investments to make to address the climate challenge, there is a new dimension that we've really got to make sure is everywhere. Development banks are, by the way, ahead of us. They're already thinking about it, but just for the audience to know, it's resilience. Now, resilience is not just physical, it's social, it's economic, it's health sector, it's nature resilience. All of these things, the SDGs are important. As we think of the universe of investments that we need to provide credit support for, risk mitigation, we've got to be thinking all the way through from emissions reductions to preparedness to make sure our citizens have a future. Well, at least that's my theory. I'm going to put that to my panel. They might think I'm crazy, but we're going to start off with, before, if I've got that pronunciation right, my apologies, from the DBSA anyway. Everyone knows the DBSA, right?
I'm hoping.
Barriers. What are the barriers here? Set the scene for us. Tell us what's hard. Why isn't this happening? And of course, what's specific to South Africa. I don't want you to stick to South Africa because I'm after lessons for the planet from you, from South Africa.
Wow, that's a lot of pressure, Sean. I must say it's quite a pleasure to be speaking on this panel, and yeah, Aqua Power is actually one of our biggest clients, I must say. So I'm gonna claim Aqua Power. Highly invested in renewable energy in South Africa. So we've actually assisted them quite a lot in terms of their projects. So coming to barriers, and hopefully we won't end with barriers and challenges. We hopefully get to solutions as well as the panel progresses. So one of the barriers, in my view, and I think it's self-imposed. It's about, there's a perception of risk, especially in emerging countries and developing countries, where investors are quite wary about investing in these environments. And it all boils down to, in my view, to lack of understanding of these environments, of lack of context in terms of, the risk assessment is quite lacking. The due diligence is not comprehensive from investors. So if you look at the performance of infrastructure overall, especially on the African continent, infrastructure performs quite well as an asset class, to a point where there are low default ratios, as low as below 2%. It's one of my favorite topics.
Below 2%? Below
2%. So when you look at consider the probability of default on a forward-looking basis, it's of course, as an investor, you must consider that. Look at the history and then look at the potential in terms of performance on a forward-looking basis. So the whole thing around risk, it's a misconception, especially in these environments. The second aspect is around Africa holistically. And I know you said I must talk about the planet, but I'm obviously from the African continent. If you look at investors when it comes to the African continent, they treat all the countries, all the regions, as if it's one and the same big country, sort of to speak. So, and that's a lack of understanding when it comes to investors from that perspective. And then we're going to touch on some of the aspects, during the introduction around currency issues. There's currency issues, expectations of investors expecting to get their return on investment in hard currency, in euros and US dollars. That obviously creates an issue of currency mismatch. And of course, energy is sold to end consumers in local currency. Then what you are then doing, you're overburdening some of these countries in terms of demanding your return on investment in hard currency. So that becomes quite an issue. Can we find solutions to that? I think in the opening, there is instruments around local currency lending that we need to develop those types of solutions even further. But overall, because of this perception of risk, investors then demand quite a high risk, quite a high return on investment overall. And if you look at on the debt side, margins are as high as 700 basis points, 800 basis points, which is quite a significant return by any means, irrespective of how you perceive the risk, right? So what you're doing is you're overburdening some of these countries when you invest in them. The other aspect is around borrowing capacity. Most of these countries have limited borrowing capacity, as we know. Overall weak type of, let's say overall weak balance sheets, and as well as no capacity to issue sovereign guarantees. Investors will typically say, can you underpin my investment with a sovereign guarantee just to mitigate some of these residual risks, be it political risk, commercial risk. But some of these countries, as we know, quite burdened from a debt point of view. Even IMF, there's IMF restrictions in terms of additional borrowing. So those are some of the issues. But overall, in terms of how we can, in a way, some of these countries can get around some of these issues, project preparation becomes quite important. Us advancing project preparation funding just to ensure that the projects are well developed, and some of these risks that we've just spoken about are well allocated from a risk allocation point of view to the right parties that are best placed to manage those types of risks. So I'll leave it there, but those are some of the barriers of top of mind.
The FX risk is obviously a very big one, especially when we're at prey of the US Fed for domestic political reasons, putting rates up and down, which ruins our exchange exposure, etc. Of course, at Asian Infrastructure Investment Bank, Rodrigo, you've been doing some work in this area. I'm interested to know your take on this at AIB. And while you're at it, you did a guarantee for the Egyptian government, a green panda bond recently, which is an example of avoiding US dollar infrastructure, currency risk, right? Tell us more about what you're doing anyway.
Right, but first, Rodrigo, I'm working at the Asian Infrastructure Bank. I don't know if you know, but we are a multilateral development bank and a new one also as the new development bank. We are going to be 10 years in 2025, and we have 110 members. So despite our Asian in our name, we actually have a global outreach, and we have right now 20 plus members in Africa, and also 8 to 10 members in Latin America, right? So, but let me first rephrase in terms of, I want to put on the gap analysis, because to get right the solutions, you need to get a good understanding of what the gaps are, and I think if some of this, I think that we do all these panels, but if for each of these panels we can have a playbook, right, or a kind of things to say how we are actually, what we're going to do different from here, right? Because we have that conversation will be very helpful. Otherwise, so my sense is, and I want to really pile on a couple of things. So we have a very simple 3 gaps analysis in terms of what we do and how we are going to actually do private capital mobilization. The first one is on project preparation. So upstream work, right? We need to be doing much more of upstream work, more actually bankable projects. And that means, blended finance tends to be confused with, it's only about subsidizing, it's all about first loss and all that. But a lot of blended finance has to do actually going upstream and preparing projects and involving the private sector in the design of the project to be bankable for them. The problem is that right now people say it's a lot of money in bankable in project preparation. There's a lot of projects that they prepare and no one actually finances, because those are not actually up to code, up to standards, or whatever. So actually coordinating after early is very important. The second one is on de-risking. And the main issue that we have with de-risking is people actually talk about risk without actually identifying what actually risks are we talking about. They are geopolitical risks, they are counterpart risks, they are operational risks, they are R&D risks, they are currency risks. So what we are actually doing is actually doing that and doing a very specific project-by-project approach of identifying which risk we are dealing with, so we know who actually going to be taking this risk. The other misconception is that risks are going to actually go away. No, they don't go away. We have to distribute them across to who actually we are better prepared for actually doing that. And the third thing is actually policy enabling. You also mentioned that, right? It says, you know, and for example, in the policy enabling environment, we just launched it in the, and this is to the solution set that you are asking. On the policy, starting there, we just created a product which is climate policy-based loans, right? We approved those in June because we didn't have them. And actually, we thought again that we were very naive and saying, you know what, we are going to do it, and you know, it's a financial issue. No, there's a lot of the things that actually are regulatory issues, and it has to do with everything that we do in policy lending now is actually linked to climate, right? And we already did the first one in Bangladesh. We are looking in India. We are looking also in Brazil. On the de-risking, so a couple of things that we are doing that now is, as you mentioned, is the panda bond. It's very good, and actually we are getting, for example, Kenya demand to do a panda bond, right, for them, right? No, but again, and we had a conversation with the African Development Bank President Adesina just today, and we are actually discussing that because we actually work with the African Development Bank in that deal. And the question is, can we actually do that, another one, right? And can do it in Kenya. And that, I mean, but currency risk is very sticky, right? And there are a couple of, like you mentioned that, we are working on some offshore, you know, mechanisms across MDBs, how to do that. That's not easy. And I don't know if you have any treasury in the room, but they are not very keen on giving degrees of freedom, right? When you say you're going to pool resources and actually manage that. So we are trying, right? But even in countries like Brazil, for example, it's still very sticky. One way that we work in is, can we work with actually national development banks? And this is like DBSA, BNDES, right? That they know more, they have a better handle of this risk at the local level to actually make those solutions. So we can actually back them up, right? But they can actually produce products that actually are more keen. The other thing that we're doing on the risking side is actually whether we can take more risk in our own balance sheet, right? I mean, can we actually have like a little bit, I don't say first loss because it's too much, but some catalytic mezzanine tranches on these things, et cetera, et cetera. But again, it's all about, you know, also working with a platform like the Global Energy Alliance for People and Planet, but it takes time, right? It takes time. We are a young organization, and the NDB probably the same place. And even in organizations like the World Bank, they still are starting now to do a little bit more of that with non-IDA money, right? So with our own balance sheet. So we are doing that evolution. And I think in project preparation also is something like that. I mean, I would say that we need to unionize more. We need to be working not only MDBs. I think the next frontier is actually public development banks. You know, it's PDB, BNDES, development, the DBSA is working not only in South Africa, it's working in other countries, right? And you have also corporate that actually now are allowed to actually issue in local currency and lend in local currency. Standard Charter can do that, 20 years in local currency in Africa. So again, I think that the whole thing is expanding, and we need to start like thinking how we're going to actually all together come to solutions.
Fantastic words. You're absolutely correct. Let's just see what Mohammed thinks, though. Does he agree with you? But Mohammed, I also want to get you to tackle Islamic finance right out. You've issued Green Sukuk, and I'm just curious your perspective on that as a way of crowding in private capital in Islamic markets as part of what you're generally doing.
Thank you, Sean. Of course, we are a multilateral development bank with a similar mandate like the other multilateral banks. We use different instruments to mobilize capital from the private sector and from other stakeholders. We issued the first green sukuk actually in terms of, and we have been actually market maker of sukuk issuance.
No, Aqua issued a green sukuk before you, but you were the first multilateral green sukuk.
Exactly. But I mean, we issued the first sukuk ever. So, and we put the architecture of Islamic finance 50 years back.
Right.
So, yeah, I mean, since we issued our first sukuk in 2019, we followed on with 2 more issuances with a total of $5 billion US. Today, in terms of sukuk, green sukuk issuance, that hit about 50 million, so it's a multiplier of 10, and many more players came to the market, so that's really good news because it constitutes a growth of 56%. But there is a lot still to be done, because when we compare that to the outstanding sukuk issuance of 850 billion, so we still have a lot to do. I mean, in terms of really appetite, it is there. I mean, there is a lot of appetite from the market for sukuk, whether that institutional or private. Perhaps on the challenge is a bit on the, I would say, the availability of assets. As you know, because to issue sukuk, green sukuk or any type of sukuk, you need to back it up with assets. So for that, as a bank, we put basically sustainability as part of our strategy and policy, and we have a sustainability finance framework. And we work closely with the member countries, and our operational team are really pushing and guiding also member countries for more, I would say, projects that meet the sustainability criteria, so that we can package them and issue sukuk afterwards. Also, we work with many partners on the advocacy side, basically to create momentum and liquidity of sukuk, because we are, of course, investor as well. I mean, through different global asset managers. And we work a lot with them and on the trading side, so that we create certain liquidity to meet also the requirement of certain investors who are looking as well for volume. So in a nutshell, I think for the sukuk, there are a lot of good news, and also for Islamic finance. Also, perhaps maybe a third point, although we call it Islamic finance, but actually it's not meant really for, it's a financial product like any others. And many of the participants in our sukuk are actually institutional from all over the world. I mean, and that footprint is expanding more and more. Also, in terms of utilization, we are tracking as well the use of these sukuk. I mean, for the 5 billion that we have issued, they financed 11 projects, so we developed certain criteria and guidelines to also track the impact on the ground. And on this space, there is a lot to be done, I think, in terms of really capturing the data and linking it really to the impact. To make sure that really we are not falling in sort of the greenwashing type of discussion and challenge that is really impacting overall, I think, the sustainability, especially in today's context. So I think today with artificial intelligence, that can be done to make sure that money is going really for sustainability, and making use of that data really to detect certain trends on how we can do things better. So this is in a nutshell what I can say, and we'll be happy to develop any further if time allows.
And it's great what you've been doing to grow that green sukuk market, or sukuk in generally, but green sukuk more lately. At a talk yesterday on Islamic finance, I predicted it would get to $500 billion of green sukuk in the next 5 years. Cross fingers, with your work, I think we can. But let me go to Svetlana, because the new development bank is generally thought of as a government to government, as a lender to public sector. But Svetlana, you're chief of private sector. That's interesting. Tell us about that, and tell us about how you see the landscape of mobilising capital.
Yes, I have good news. So first, our strategy requires 30% of our funds until 2028 to be invested in the private sector projects. So we are in that business. It's growing, and so this is our priority for the moment. The second good news, so that we do not going to do this alone from our own balance sheet. So that's why. So the second pillar of our strategy is mobilization of their private capital. And with this, we started to think how to do this and where are the needs. Truly said so, I think that we have now 6 member countries, and we see the more issues for mobilization of the private capital for the lower rated countries. And we started to think how we can deal with this. And so the primary challenge we see in, let's say, these countries, their credit rating. If you go to for funding of the commercial banks, so it consumes a lot of capital from their side. So as a result, so they might be constrained on their obligos limits on those countries, and they have good origination skills, they have excellent capacity to do the deals, but they are constrained. And we have a AA+ rating. And so the transferring the risk of a well-structured climate green projects to us, potentially we see as a solution of mobilization. And without necessary just leaving them small space of co-financing and so on. We think that this might be this partnership with commercial banks might be the way how we do in our private sector operations, so the mobilization. And that's why we come up with the theme of today's seminar as risk sharing. So because to support this growth, we think that the main would be to release the capital of the private financiers so that they can do more. And for that, we need to share the risk with them. So maybe I stop here for the moment, so then discuss it later in the second part of our panel.
Well, let's go to Thomas first, because they're actually building kit. Risk sharing sounds great, especially if you can offload all the risk and keep the returns. But how's this working? What are the barriers really for you? And also, give us a bit of feedback on what the development banks here are saying. It'd be especially nice to DBSA, of course.
Thank you. So first off, good to be on this panel here and see some familiar faces. But let me just quickly introduce Aqua Power, because we have been around now for 20 years, and you're quite right. Started out as a company a lot more focused on thermal and then fossil fuels. Fast forward 20 years, quite a Cinderella story. Now a very large, one of the largest companies in the clean energy space. So large projects, that's certainly what we do. And just to give a couple of numbers, what we're looking at, we basically decided last year as part of our refresh of our strategy to triple our business. And that basically means for us, already we have $85 billion asset under management. It's a gross number. We want to take that to 250 by 2030. So another more than 150 billion we are looking to deploy over the next 5-6 years. More than 90 projects we have, and just a couple of highlights. Also our, I would say, flagship green hydrogen project in Saudi Arabia is massive. 8.5 billion, of which 6.5 was project financed. I think it was 23 banks, 17 international and 6 local. Just last month, 5.5 gigawatt was brought to financial close in Saudi Arabia. Now, that is our home market, but increasingly we are looking also to expand in more, let's say, emerging markets. And if you look at our footprint and where we're investing, then essentially we are investing out in the Gulf region, but in Central Asia where we are now. And as a matter of fact, Uzbekistan is our second largest market with about $15 billion we're looking to invest over the next few years. And also have investments in Azerbaijan and Kazakhstan. Africa, an important market for us. We've been there for more than 15 years. South Africa in particular, we are present in with our CSP. We are bidding into many projects there, so important market for us. And of course Southeast Asia, and then China is where we are playing right now. I think as a developer, you're looking at how can you get the risk-return equation right. And when you go to some of these markets outside the Middle East, where, I mean, Middle East is quite cutthroat. So there you're looking at mini-perms, you're looking at EBLs, you're doing everything to really win the competition. It's quite different when you go to some of the other markets. So there you're looking at different protections. You have to understand the local regulatory framework very well. Permits is another thing. You want a one-stop shop instead of multiple layers. Those things are very important. We are, of course, looking at the financing and take quite a lot of comfort that the multilaterals and the DFIs are with us. They know the market well. They help us with the due diligence, and of course, that's the nature of non-recourse. So important to us. We are using PRI, we are using MICA coverage in certain cases as well in these places. And of course, being bankable, I think what we've seen, and I think Central Asia is a good example of when project finance and non-recourse is new, it takes quite a lot of time to actually get the template right. And we spent a lot of time on our first project, Sidaria here, which has now been used as a template for other projects. So bankable and getting to that stage where you can basically run the process more smooth is actually one of the things we're looking at. And then I'll just say generally, there's a lot of stakeholders. There's the lenders. You have maybe equity partners. You have NGOs. You have grids. You have regulators. All have to be happy. And what we're trying to do is get as much protection as we can, which also means that we can lower the tariff and we can basically pass on the benefits also to the ratepayers. Thank you.
Which, of course, in emerging markets looking for low-cost power to develop is critically important. And the cost of capital is such a huge piece of the puzzle when it comes to high capex, low opex investments like solar and renewables. So this story is central to making this work in emerging markets. Look, I'm after now a little bit more granular detail. I'm going to start with Mofo first. There's a bit of a talk, bit of chatter about relationships between national development banks and MDBs. How has that actually worked in practice for you in terms of mobilising capital? Can you give us some examples, hopefully positive?
Yeah, no, it is positive, I must say. As a matter of fact, the new development bank has given us some money to invest in renewable energy. So I think it's about 300 million US dollars, if I'm not mistaken, and we've deployed all of that capital, of course. And coming back to Aqua Power, I actually met Aqua Power about 12 years ago, or 14 years ago, at the inception of the renewable IPP program, which is the case in point that I want to mention. So when Thomas says we're in South Africa, he's actually talking about investing via the renewable IPP program, which is a program that we, as the DBSA, we championed about 14 years ago. Someone was talking about a platform, a template, actually. I think that's the word that they use. So we developed a template or a program in the renewable IPP program. And that program managed over time to, we managed to procure about 7,600 megawatts up to now, with an investment amount of about 254 billion rands, which translates, give or take, between 15 billion US dollars to about 20 billion US dollars. So we managed to unlock a lot of private investment via that program. Now, I think your question is about what are some of these success factors, and we did say let's get into solutions. So the success factors, using that program as an example, is, first of all, we adopted a programmatic approach, the template that we're speaking about, in terms of ensuring that, there's a standardized procurement process. And the second aspect, we're able to achieve economies of scale in terms of the investment costs over time reduced, right? It's been 14 years in the making. As the various bidding windows came down over time, progressed, the investment costs came down over time. And that then influenced as well the cost of capital. The cost of capital reduced over time. And all of those, as we know, if you look at your financial model, that features, those are your key inputs into your financial model, and they influence the tariffs, energy tariffs. So tariffs over time reduced because of that template that we adopted. And coming back to project preparation, very important as well. Most of the projects were prepared by the private sector. licenses and permits. We had various, public sector, spheres of government that, had a coordinated approach in terms of licenses and permits, accelerating the project development aspects of the program, ensuring that we've got this coordinated approach. Then government obviously underpinned the entire program in terms of government guarantees. The off-taker being the utility, national utility being ESCOM, was not that credible according to investors, right? And so are many utilities, by the way, before you come in.
Absolutely right.
So
Absolutely
many utilities. So because of that, investors were looking for an underpin from government. So a government guarantee was issued just to wrap all the residual risks underpinning, underlying that program. The likes of Aqua Power then participated, etc., etc. Coming back to the local currency issue, we then insisted that, the energy tariffs under the power purchase agreements have to be in local currency. Investors had to make a decision whether they want to participate or not to participate. South Africa has got deep capital markets, unlike other emerging countries, developing countries. So they chose, of course, because the program itself was well structured. So that's the starting point. Once a program is well structured, the risks have been appropriately, I wouldn't say mitigated, but allocated to the best parties that are capable of managing those risks. Then investors are able to come into that market and play a role in terms of investment. So that program, of course, then unlocked a lot of private capital that way.
It's a very cool story. They're big numbers in terms of deployment to renewable energy in South Africa. I mean, I know the need is vast, but that's actually quite a big success story. Rodrigo, you were part of that story, I fully appreciate. But just thinking more about the private sector engagement in general, can you give me a bit of a sense of how to build confidence across the board and mitigate it? What's really working best for you?
Right.
Putting aside the DBSA story we just heard about.
Right. I again, that's absolutely right. I think financial alchemists, the financials are not that difficult, right? I mean, the structuring is not the main issue. The main issue is actually to have a good understanding of what are the risks that we are dealing with and how we're going to distribute them, right? And I think, in many ways we are looking for developers that had an established, in the market for, again, 10 years. So there's a lot of that. I mean, we are also a new organization. So a lot of the things is actually, there's not so much, some things like you're going to have a bunch of money, even if you have your board that give you a lot of money to play with, right? It's not many developers out there that are going to actually, you're going to be integrated with, because they need to have an established reputation, they need to have a track record in actually dealing with this market. So I think that, and the other thing that we have to do with the case of AIB, and that's why the development banks actually, the national development banks are more important, is because we don't have country offices. When you actually want to do private sector financing, when you don't have country offices, you don't have the markets, that sort of, you need to rely on your partners to actually do that, right? So we do a lot of what we do for private capital mobilization is actually financial intermediation, which is, you mentioning what is our role working with, we actually do a lot of financial intermediary funds, right? And basically we actually believe that they are in a better place to distribute, to allocate that money than we are, right? And this is a very catalytic way. So we back them up for them to actually invest. And it's a lot of that what we actually do, and also through funds, right? I mean, you have those things which people don't like funds and other people like funds. I think for building our book, it actually makes sense. And in particular, when you don't have boots on the ground. Doing direct equity investments when you don't have actually local knowledge is very, very bad. I mean, your board is not going to, or your risk department is not going to like it. So we really are a sort of catalytic, the way that we do it is catalytic. The other one is capital markets. I mean, the underwriting of capital markets is another way of actually doing that. I think the tension comes because there is a lot of need. I mean, you can tell me, obviously, but there is a lot of a need for equity, right, in these markets. In particular, when you're talking about climate, there's a lot of that as R&D. It's a lot of that has to do. You have the developers to actually put their own capital at risk to actually going to do that, right? I mean, and actually you have a problem of the off-taking. In India, for example, it's a very much developed market. And I think that what we also trying to do is, can we actually develop in India and replicate somewhere else? Because they have the internal market to have the advanced purchase agreements, the APAs in place, for example, for hydrogen or other technologies, where you feel comfortable entering that and putting equity in there because there is the off-taker is there. But again, we need to be realistic about these things. I mean, the idea that we're going to go tomorrow and going to start like financing hydrogen in some African countries very low is not, I mean, to me, it's either greenfield in less developed markets, or brownfield in well-developed markets, but actually doing new is actually quite hard for us, right? So I think that is the way, my sense in all this is, bottom line to me is, there's no I mean, it looks like, a repetition, but it's no one size fits all. We need to have a good understanding of each of the projects, each of the investments, and many of the things are very different depending on where we are. And I think, when we need to have a pathway to actually do this. And my sense is, again, looking at what is happening in India, what is happening in Saudi Arabia, right? All the things and how we're going to actually invest there and then replicate that is actually the way to go.
Okay. Well, I'm just going to make that a segue to Mohammed now, right? Because this is a big and complicated issue. What's been your experience with effective risk-sharing instruments for private infrastructure and so on? Tell us the Islamic Development Bank story in this. What's worked?
Yeah, I mean, of course, what worked for us is a deep knowledge of our member countries, because if you look out of the 57 countries we have 26 in Africa, and the rest are in Middle East and Central Asia. So we are really very much in sort of risk sharing and risk understanding and mitigation. We maintained our AAA rating for the last 16 years, okay, and we are fulfilling our mandate really in terms of really deploying financing either to finance governments or the private sector. And we are doing that through different instruments, basically the usual, I would say, project finance instruments, and also the type of risk mitigator around that, either through our insurance affiliate or in partnership at times with other multilaterals like MIGA or insurance companies within the recipient countries. So we work a lot on the structure. I mean, as Rodrigo mentioned, I mean, it's very much structuring type of, and see what type of risk we take and what type of risk we mitigate and we ring fence. Also, I mean, the selection of the projects. I mean, if a certain project, while assessing it, it doesn't make sense, I mean, we engage really very much at times in extensive discussions to make sure that the studies are very well prepared, and also give, I would say, a realistic a realistic strategy to implement the project within a certain time, and also mitigate all the risks around it. Also, what worked for us is on the mobilization side. As I said, I mean, we are ourselves investors. We have invested in more than 50 funds today as an LP. I mean, 50 active funds that we have. And all of these funds are co-invested with other multilaterals. So given that we have a lot of overlaps in terms of geographies or at times thematics, so we invested a lot there, and that is closing the gap on the equity side, as Rodrigo have mentioned. I mean, to make sure that the project is properly funded, especially the infrastructure projects that tend to be very capitalistic. Also on the sukuk side, as I have mentioned, I mean, we come to the market 2 to 3 times a year, and we have done a lot on the, I would say, the knowledge sharing part through our affiliate, which is IDBI, our research institute in terms of training and sharing information on how the structure and how to broaden the market and bring more player in this space. We worked also with the various regulators in terms of really putting the right regulatory framework to basically be able to offer Sharia compliant products in the various constituency. And that really has worked very well, because if you look at, we just celebrated our 50th anniversary. Touch wood, still now we didn't have any sort of situation where the industry lost credibility, even during the most difficult times of the financial crisis and all the noise where many people lost a lot of money, because Islamic finance in itself is very much asset-backed and it's about the real economy. So that really gives us a good track record to build on this. Yeah.
You've been hearing here a story about the essence of what a development bank needs to do, which is to understand risk. The deployment of the balance sheet is one thing, but that comes after better understanding the risk than anyone else. And then we make more informed decisions in the areas of focus. That's what you're hearing about here. Of course, there's still always a challenge about speed and support for the private sector. Svetlana, from your perspective, in this 30% allocation, what do you see as the challenges? I'm going to say the solutions.
Right.
Thank you, Rodrigo. As Rodrigo says, the solutions that are working.
Yes, we already discussed challenges a lot, so let's discuss solutions. So first I would say that because you mentioned relations between the national financial institutions and multilateral, just to add, because MDB started its business by engaging with national development banks. Like DBSA was probably one of our first borrowers in South Africa. And then they deployed our funds to multiple renewable projects. And now we did the second loan. And the same was a strategy in Russia and in Brazil, where we worked with the BNDES and other local development banks. But this strategy does not involve the risk on our side, right? Or we're taking the risk of well-established government-backed banks. Obviously, we count on their knowledge as well, but this is the first stage of development. So that's why now we're looking for solutions where we really crowd together with potentially the partners from national financial intermediaries. We crowd in the private sector capital. And it would be very different country from country. In South Africa, so the program is financed by the capital markets and so the local banks. Risks are well understood, so they structure very aggressive financial terms. But so this is not yet the end of the needs of the country. So the next program is coming with transmission, and the more capital would be required. So where is the solution? Would these banks will be so comfortable to take in new risks in a slightly different contracts environments? And we primarily look to understand how can we now take more risk, so that private capital is in, so they have lots of liquidity, they do not need funds from us. But so that it's not only preparation, as I said, so they well understood those markets. They have excellent origination capacity, much better than us. Well, we have office in South Africa, so these banks much better than us. So, but we think that to crowd in them in new, more risky areas, subsectors, so where they're less comfortable, we need to share the risk with them. So that's why our strategy and solution is to make the partnership with commercial banks. And continue to partner with national development banks, but not only lending to them, but again, so doing the same risk-sharing partnerships with those. I've been in Brazil. I just returned from Brazil, and almost at every meeting I heard about the guarantees. So can you provide the guarantees? And obviously the guarantees of various kinds, some kind of we could provide, some kind of not. But so this is a big word, I would say. So it's not only give us money. So primarily the people were saying, we have money, but can you please give us some comfort on sharing risks with us? So that's why we move in as a solution in that direction. So this is probably a way to crowd in really the commercial lenders with good funds, and so give them a bit more comfort on certain risks.
And there's a whole global debate going on around guarantees and development banks at the moment. Everything from better utilisation of balance sheet along these lines to how do you treat guarantees in your balance sheet? Do you treat the full value, or do you treat them like an insurance company does, which will allow you to do 10 times as many guarantees for the same dollar? It's a big area of discussion, a very important area of conversation. But now I'm interested in how Thomas views this, because he's got to do what really we want every company and government to do, triple their balance sheet or their exposure to these areas because of the scale of what we do in emerging markets. Are what they're saying enough for you? What pick and choose? What do you need most? What's most useful for you? How are you going to get to the triple easily?
I don't know how we're going to do that easily, but I think for us, I mean, generally I would say we have a business model where you are trying to put the risk to the ones who can take the best. And if you look at it, we're quite happy doing the development ourselves. But then already at financial close, typically we would like to invite in other equity partners. So that's the first, the risk sharing we have. And then in the construction, we would work with EPC, who knows exactly how to construct projects, another risk sharing mechanism. And of course, when we work with our lenders and we do, as I said, non-recourse financing, that's another way of looking at how you share risk. I mean, that's the key ones if you look at it in a simple way. Now, I think for us, when you come in and you look at new markets, what you're doing is look at market fundamentals. You take a long-term, we as Aqua Power take a long-term perspective. So what are the political risks, what are the economic outlook? And then you sort of make your business plan as part of that. And I take the example of, for instance, Nigeria. You can go in and take a look at, okay, you have a lot of diesel generators. You can put rooftop solar or PV solar at a 20-25% cheaper value. Good business case. For us, that sort of sets a bit the tone of, okay, what is that then risk return you want to take against what is the pure commercial opportunity in a market. On the risk sharing mechanism, I think again the guarantees are important because, as I said earlier, in many markets outside the Gulf region, we kind of need these kind of guarantees to be competitive and also get reasonable tariffs to the ratepayers. So that is important for us. If we can, we also have good example of working with sovereign wealth funds and government entities, Silk Road Fund here in Central Asia. We're working with Mazen in Morocco, and those kind of things immediately also de-risk a lot for us because, of course, you have access to decision makers in a different way. I think on the financing, I mean, we touch upon them. The PRIs, the ECAs are important for us when we go in and make our business cases, and it's important for our board. So we look at those. Transmission is another thing we typically discuss, different models. Do you build it yourself and you transfer it back? Who can take that risk the best, also when you have to finance it? And of course, generally working with your local communities. I mean, South Africa, again, if you can get really grounded in the local communities and you have, for instance, BEE in South Africa, part of your equity or equity partnership, I think that's all part of de-risking your projects. So we look at it probably a little bit more holistic. There are different mechanisms that, of course, we are talking to the banks about, but typically it's quite hard to find ways that becomes actually competitive and ultimately gives a better tariff.
So we're going to get to the 3 times. That's fantastic. He's he's reassured me. I want to see if there are any questions from the audience at this point. You know that the challenge of cost of capital is everything when it comes to the green revolution, because this is a high capex pathway, but low OPEX, the way we're looking. So getting the cost of capital down is really central to rapid transition, which is what we need. And that's what we've been hearing about today. But of course, there are different variations on strategy, different paths forward. Anyone got any questions they want to ask, or ask for money even? But no, I'm just joking. I'm just joking. Please take this microphone.
I'd love to ask for money and ask them to compete. My name is Edith Adera. I work with the African Development Bank in the Climate Change Department. This has been an interesting discussion. I must say that I've learned a lot. I've just come from a different discussion looking at what's the role of small and medium enterprises and how can they play a role in terms of being financed to close, for example, the energy gap, because about 600 million people are not on the grid. Yet you have a lot of SMEs that can actually provide off-grid energy solutions. But what we've been talking about is very big money, but can we use intermediation, maybe through regional and national banks, to be able to on-lend and make sure that they have the capacity and you've handled all the risks? I think that way we'll be able to combine both very large aqua power kind of companies and also smaller SMEs that are making a big difference on the ground, especially young people, very innovative, using fourth industrial revolution technologies to actually deploy energy. If we look at energy as an example, how can they play a role? How can we finance them?
Any other questions before we go to the panel? Please, at the back here. Oh, there you go.
Thanks. Chris Sherwood from the Negative Emissions Platform, which is an industry association for the carbon removal sector. I just wanted to know if you had come across carbon removals yet in your work, and if you have identified any unique challenges to carbon removals as compared to other avenues towards decarbonization.
Do you need funding by any chance? Just checking.
No, I run an association, so no. Well, yes, but
that's okay. Just joking. Because it is a big, important area, and it does need a lot of funding going forward. Please go ahead.
Hi, Kokezo Moragile from Absa Bank. I just had a question for any of the panelists. I think we've had a lot of conversations thus far on transition finance, and I think coming from a South African background, the topic of transition is one that's an imperative for our economy, and I think most economies across the continent. Within that context and thinking around, ideally we'd like to go from brown to absolute green overnight, but we understand that that is a transition in of itself. How do the development banks then balance a lot of the exclusions that are on the list of fossil fuel sectors that they wouldn't support from a funding perspective, and this imperative of transitioning and supporting that greening aspect of otherwise hard to abate sectors? Thanks.
Great question. Do we any more? Oh yes, please. Take my microphone.
Hey, can you guys hear me? Yeah, okay. So, hey, I'm with MDB. I work with the Office of the President. My question, we talked a bit about equity today, and I wanted to understand a bit more, similarly to the first question, what could we do in terms of on-lending to support some of the technology aspects that are important for these, for the climate transition? So I mean, for example, how do we support technology innovation and deal with this problem of numbers that are too big?
Can you hear me? Yeah, okay. Well, this is Rwanda. I'm working also with the New Development Bank under the strategy team, working on the climate issues. I have one general question to any of the panelists. So actually, we have been talking about private capital mobilization for years. I mean, almost every COP, like this will be a topic. And we are still talking about it. So my question is actually, based on your observation, do you actually see an increasing appetite from private sector to actually invest in climate agenda? Not only mitigation, for instance, I mean, aqua power is renewable energies, but I mean, there are lots of investment already in renewable energies. Everybody's talking about renewable energies, but my question is like, yeah, besides renewable energies or some of these technologies, any other interests actually coming up from the private sector in also, for instance, in investing in adaptation measures like nature-based solutions, biodiversity conservations, and other types of projects in very important in the climate discussions. Thank you.
Okay, that's a menu of questions for you to tackle. Who'd like to pick your questions you want to go with?
I'm going to tackle the SMME one. I'm not an expert when it comes to SMME finance, but I'm quite passionate. I think passion helps. So
absolutely.
Yeah, so both Thomas and NDB spoke about transmission. One of the things that constrains us now in terms of building new renewable energy capacity in South Africa is transmission. And I think not only in South Africa, I think globally, a lot of us are struggling with grid capacity constraints. So we are now currently developing a transmission program in South Africa because we need to build about 14,500 kilometers of transmission lines over the next 10 years. So the question then is, how do you leverage that transmission investment program, which is going to, we need to mobilize a lot of funding, a lot of investment. How do you leverage that transmission program in order to stimulate economic growth? How do you leverage that transmission program in order to bring in SMMEs into that space, right? Yes, SMMEs cannot compete with the likes of Aqua Power from a balance sheet, capacity point of view in terms of building these big, transmission lines or power plants, but they can definitely play a role across the entire value chain in terms of providing some of the key components. Components as simple as steel, whatever it is. So as part of now us designing and structuring this transmission program, that's exactly what we're doing. We're talking about building EPC capacity, bringing in the SMMEs in order to dig up trenches, civil works, in order to provide some of the key components. We're actually analyzing the entire value chain, not just focusing on transmission only, which is the infrastructure at the end of the value chain, but also across the entire value chain. How can SMMEs play a role in terms of providing some of those key components from a construction point of view? We're actually taking that quite seriously because we're looking at it as part of stimulating economic growth. That's exactly how SMMEs are going to play. There's obviously aspects around skills capacity as well. We're trying to close some of the skills capacity constraints where SMMEs can play quite a significant role. Thank you.
Mohammed, then Rodrigo?
Yeah, I want to touch the innovation part, transition part from the lady of South Africa. On the innovation side, I mean, the way at least we are tackling it at the Islamic Development Bank, I mean, every year during our annual meeting, we organize like a business plan innovation competition. And the themes are very much around climate and others. So we try to encourage more startup in this space. Also, we support it through investment as LP in certain innovation funds that invest as well in technology and the ecosystem that really helps climate. I mean, today, when you talk about data centers and others, especially also, that more AI is used basically by whether power companies or others, so that's very much important. So that covers this bit. Of course, more needs to be done in this space. And the transition part of it, I mean, we are doing it gradually. We set for ourselves 35% target by 2025 because many of our countries, as I said, I mean, they have really a lot to do, really, to transition at once. it's very much related to the cost of really transitioning there, and also making sure to maintain also affordability and social peace. I mean, we cannot move just overnight like that. And of course, we will be pushing this gradually so that we build more and more, I would say, climate-related assets so that we can securitize without really disrupting really the economies or the setup in member countries.
See, I think they are connected. First of all, on the SMEs, I think it depends on what the SMEs will do and what the SMEs actually need. I mean, they are on lending, and again, straightforward on lending can actually get you there if what you need is just, and if these guys or other more local, they can actually take those risks. The problem is that the risks don't go away, right? I mean, if you actually need equity and you are going to be using that money to do R&D, right, to your point, that we don't know. I mean, I would say that we don't know how to do that at scale. I mean, I spent 10 years at the Gates Foundation before coming to the bank. And I actually ran developing the finance program. And we have a huge problem to actually scale innovation. Because we do a bunch of these kind of startup parts, right, and innovation funds, but no one actually was going from 50 or to 20, from 20 to 100. So I think that's a tension in the system. So I wanted to sit down here and believe that we actually figured it out. And I think we have a big problem there, because we need to accelerate the productization and the acceleration of the speed of what technologies come from zero to the market. We don't have 20 years, we have 5 years or whatever, right? The way I'm finding now, right, is pretty much, as I said before, is no hoping that we are going to accelerate, for example, in Africa, that is actually saying, well, can we accelerate in India and then get India to see how we're going to do it in Africa? Be more agnostic of where the actual innovation happens, in order to then actually do the spillover. And this is, I mean, there are very different ways of how to do R&D. There are people that say and vaccines exactly the same thing. The issue that we got in COVID was that we don't know how to de-risk R&D. And the only guys that were able to get the vaccines were the ones that actually were able to actually finance R&D without APAs. And this is what happened. When we tried to actually do it with COVAX, we couldn't do it. So, I mean, if we have another pandemic right now, we're going to have a same situation. And my point is we don't want climate to have the same thing that COVID here. Because the issue that you only have the rich countries that are able to absorb those risks, to do innovation and actually benefit from innovation, is actually, we don't want that in climate. So I would say that we need to get together to actually do that. And Andrew Steer said that we need a deal team for the planet, right? And I think that we really need that. And I think R&D is something extremely important that we need to get right. My sense is more agnostic about where that happens and see how we can transfer that technology. And if we do let go on that degree of freedom, then probably we can actually have a chance. And again, looking at the markets where that's happening, India, for example, Saudi Arabia, that actually gives us an edge.
Thomas, do you want to answer any of these? Please.
Yeah, let me make two quick comments. Maybe first also just to the SMEs. And of course, when you look at the value chain, you're absolutely right. We use a lot of SMEs as suppliers. And quite frankly, we like the suppliers also to be local. So when you're building solar farms or wind farms, actually having local SMEs that are part of the project is a huge, huge help. So that is one area we are very, very focused on. So that's definitely a big role to play there. I think on the private capital, on more innovative solutions, I think when you are a commercial outfit, there is a limit to what you can do. But for instance, and I think Aqua Power is pretty bold, that the green hydrogen investments we are doing sort of at the forefront, there we are willing to put capital in, even if you can argue that the risk return, you can argue is that in the right, in sync, basically. I think concessional or blended finance there, it's something that we're not seeing enough of when it comes to, for instance, green hydrogen. So those areas we are focused on. R&D, if you want to stay ahead, private companies will always do that ourselves. We are spending tens of millions of dollars ourselves. Water desalination, we've been managed to take, the power intensity down from about 15 cents to 3 cents for water desalination, basically driven by our own investment in R&D. So you can still do a lot, but it has to be within, I think, the commercial boundaries.
It's
Thank you. So I would like to link maybe a few things: mobilization, SMEs, and the technology transfer of knowledge. Not only technology, because I think that we work in different countries, and we see how solutions or projects we do in one country can be actually applicable in other countries. It's not our project; it's a AIB project, but we also looked at it in China. So where the microfinance organization, which has excellent access to the rural small households, now doing the rooftop solar installations for those rural households. So they changed from just lending, so the microfinance, to doing something completely different, and this is very, very interesting. And I know that the IB did a big research for them, so paying grants to do how to do this. And now I think that this could be transferred as a knowledge to the other countries in which we are working or AIB is working. So first answer is yes. So the small households or SMEs will play a role in the green and decarbonization. So we will work through this kind of intermediaries, but they need to find the willingness and the solutions, probably with our help. The other example is from the Mr. Kishore's country, so from India. So this is a project we are now bringing for final approval in the bank, where we will lend probably to 14. Ultimately, we lend to the financial intermediary, and they own land to 14,000. It's our estimation of beneficiaries for purchasing the electric vehicles. So this would be the first owners. So the converting to the drivers, it would be for commercial use. They will start to earn some money, electrical or CNG vehicles, so which will reduce the carbon emissions within the most polluted and industrialized states of India. So there are obviously this kind of companies. They're doing great business, and they're willing to go from their common business into more sophisticated and more green solutions with our help. So this is, and I think that we can. So what we learn, we can share this experience from one country with other countries. So this is what I wanted to say. And on mobilization, so we're not only giving them the funds. So and said, okay, here's $100 million, please on lend to this type of projects. We're asking them to create a bigger portfolio, and they are ready to do this and do the same type of the financing, so as we structured with them. So multiplied by 4. This is already mobilization of the private capital for these smaller SMEs or bigger projects, it doesn't matter. So we're always trying to not only lend our funds, but agree so that they raise funds from other sources, from their own capital, so that our program is scaled and multiplied. So this is how we approach it.
Thank you. We need to wrap up. I'm going to ask all the speakers for just a parting reflection. Can we do this in a tick? Just before, I want to add a couple of my comments. Carbon removal is clearly important. Brazil is currently putting together, I think it's about $2 billion initial pipeline of nature-based solutions investment. And then, of course, we've got the direct air capture story, like Occidental Petroleum under the IRA. That direct air capture is requiring big subsidies at the moment, tax credits in the US. But these are clearly all things that we need to do going forward. Whether they're viable, well, longer conversation, but great the work you're doing, I want to say. On the transition, I want to stress that while we look at transition, like the just transition to conversation in South Africa, which is essentially about what to do with mine workers, etc., there are different forms of just transition. There is a smooth transition required, which is about avoiding blowback. That's where the mine workers conversation sits, because we can't afford this change to be set back by social unrest, not just from the directly affected, but from other people who are negatively affected. The biggest transition is transition to resilience. What we can't afford is people being negatively impacted by climate change and losing livelihoods, not being able to farm because crops fail, or otherwise being dislocated, because that will also set everything back. We need to bring people with us. So there's clearly a lot of dimensions to transition. Really good points you make. I want to make sure that stays on the agenda. I also just want to stress, lastly, that private capital mobilisation scale, we need to understand, is extraordinary. It's not the tens, the hundreds of billions, it's not even the low trillions. According to McKinsey, globally, we need to move about $9.2 trillion a year just on the mitigation side. And we have the resilience side, which is an equal pipeline. A lot of that will be recalibrating existing investments. As IIB invests in infrastructure, they're now looking at making sure the procurement requirements for that infrastructure address resilience. That's what we all need to do. But it is a vast pipeline. So on that point, I want to go back to our panel and say, parting reflection in that context. I'm going to start at this end of the table.
Okay, no, so I think I'll come in from a positive note. So yes. I remember when costs were always prohibitive, and now at least renewables is the cheapest and the most competitive. So that's very, very positive. I think the constraints we have are more geopolitical. It's interconnectors, it's the land access, things that we need to work around. And actually also on the financing, the liquidity, it's there. I'm less concerned about that for what we're doing. I mean, these are big numbers. You still have to mobilize. But generally, when we look at the projects available to us, it's not the liquidity we're struggling with.
Great. My part way is like, again, we have to focus on what we have done. I mean, there have been a lot of progress, right? And I think we have been getting the fundamentals right. I mean, intermediation, right, on lending, all that. Now we need to get to the next frontier of binding constraint, which is R&D, how we're going to get the scale, how we're going to accelerate these sort of like things. And then the other positive note in my mind is that now more players are coming to play. I mean, this conversation is because the NDB is actually keen on doing that. We in the AIB also, we are doing that. So we are coming to that understanding. I mean, there's a good movement, you know, Ajay Banga from the World Bank, right, is pushing a lot, right, to IFC. We have more warranties at scale with MIGA, right, centralizing warranties, which is, you know, the other one, originate to distribute, right? This understanding what NDB should play, that we should not be warehouses of loans for 50 years, which I don't know, you know, but actually we need to originate and then distribute that thing, securitization, all those things. So I think very things pay together. I think that what we need to get there is actually a little bit more granular on the problem definition, right? When we think about hydrogen or we have the new technologies, can we actually come together, you know, for those who actually understand those things and put that deal team together to actually get it done. So I think that, but again, I'm very hopeful that again, that we are going to start like going to the next frontier.
Yeah, I think on my side, thank you so much. I think it's been quite an enriching discussion today, and hopefully I've done a good job. Hopefully we'll get low cost of funding from these other, you know, multilateral development banks that are sitting here. So that's why I came, by the way. So we are on a path on our side to develop a transmission program. As everyone has mentioned, we want to replicate the successes of the Renewable IPP program, but we've got to do things quite differently. You know, we spoke about, you know, including our own government, issuance of government guarantees is not going to work. We are looking at a model, or at least a credit enhancement mechanism, called a credit guarantee vehicle with the likes of the World Bank, which is a new mechanism in terms of trying to then credit enhance the entire program. So we'll see how that can work, and we're looking at that type of a model or that type of a mechanism then being utilized to unlock other infrastructure programs of a similar nature as well. So we're looking at that type of avenue. I think we spoke about project preparation, the importance thereof, very important in order to ensure that projects do reach a bankable feasibility stage. As DBSA, we do provide project preparation funding in order to unlock a lot of these projects. Equity as well is quite important. We do fund on our side a lot of these local players. Thomas spoke about that, the importance of ensuring that local communities are involved in these projects. So we fund a lot of local communities, local players, these SMMEs that would like to get into this kind of space as well. Very important.
He makes a good pitch, Mohammed, doesn't he? Please.
Yeah, at the break, I will discuss with him the grinium, the premium. I think more needs to be done on the innovation in terms of products, to come up with more instruments really to finance climate. Also, Sean, you spoke about the treatment of guarantees, and I think we need to make good use of the CAF report. I mean, it's on the table there for MDBs, and to make sure that more balance sheet space is actually created, for MDBs to be able to finance more. And definitely on the guarantees, because as a risk mitigator, I think this could encourage maybe more private banks and to come into play as well to help in this mobilization effort.
Thank you. Svetlana, the last word.
The last word is thank you to the all panel members, because we are the host, and so we're really great that they came. So thank you so much.
Thank you.
Please, hope. This is hope. Get them back a big clap. Thank you for being here today, everyone, and thank you for joining us on the stage.
Great moderation. Fantastic.
Thank you, Svetlana. It's a good video. Thanks.